Buying a home might be the only purchase where people celebrate taking on 30 years of debt like they just became financially free. You sign a stack of documents you barely understand, hand over most of your savings to people you met a few weeks ago, and then someone gives you a key, snaps a photo, and says, "Congratulations, you're officially a homeowner." And maybe that really is worth celebrating. But the economics behind it aren't as simple as owning good, renting bad. A home isn't just an investment, and it isn't just an expense either. It's several different financial decisions bundled into one very large purchase. You're buying shelter. You're borrowing a large sum of money. You're making a leveraged bet on one local property market. You're locking a chunk of your wealth into something that can take months to sell. And you're buying control over where you live, which matters more than people give it credit for. But before we get into what that control is worth, we need to look at what the numbers are actually doing. Because your mortgage payment isn't the cost of owning a home, it's just the most visible part of it. As of July 23, 2026, the average 30-year fixed mortgage rate in the U.S. sat around 6.58%, while median home prices stayed above $400,000. Harvard's housing researchers estimated that by late 2025, the monthly payment on a median-priced home had climbed to roughly $3,100, which, under their assumptions, required an income above $120,000 just to comfortably afford it. That's the first reality worth sitting with. The price on the listing isn't the number that determines whether you can actually afford the house. The monthly system built around that house is. So let's take a $400,000 home. Put 10% down, $40,000, and you're left with a $360,000 mortgage. At 6.58% over 30 years, principal and interest alone comes out to about $2,294 a month. But you're not done yet. Add property taxes, homeowners insurance, probably mortgage insurance since the down payment was under 20%, maybe HOA fees, then maintenance, utilities, repairs, and eventually the air conditioner that worked perfectly during the inspection and then quietly gives up 3 months after you move in. The CFPB actually warns buyers about exactly this. Your total monthly payment is almost always higher than principal and interest alone because taxes, insurance, and mortgage insurance usually get folded in, so that affordable-looking mortgage payment can turn into a very different total housing cost once everything's added up. And that changes what equity actually means. People love to say, "At least my mortgage payment is going into my own pocket." Some of it is. A lot of it isn't. In the first year of that $360,000 mortgage, you'd pay roughly $27,500 in principal and interest combined, but only about $4,000 of that actually reduces the loan balance. The rest, more than $23,000, is interest. That doesn't mean the mortgage is a bad deal. It just means amortization is slow at the start. Your equity is growing, but nowhere near as fast as the size of that monthly payment might suggest. And the down payment itself isn't profit. It was already your money. You just moved it from a liquid bank account into an illiquid house. The same trap shows up when people calculate their return. Say you buy for $400,000 and eventually sell for $500,000. It's tempting to say, "I made $100,000. Maybe. But first you subtract the costs of buying, then the costs of selling, then the repairs, the improvements, the taxes, the insurance, and the interest you paid the whole time you owned it. Only after all of that do you actually know what you made. Fannie Mae studied this over a typical 7-year ownership period and found that ongoing non-mortgage expenses made up more than half of total ownership costs, while transaction costs from buying and selling made up roughly another 20%. That's why time matters so much here. A home purchase has friction on both ends, money spent getting in and money spent getting out. Spread across 15 or 20 years, that friction becomes manageable. Squeezed into 2 or 3 years, it can eat a huge chunk of whatever appreciation you were counting on. Which is really what buying a home comes down to. It's less about predicting prices and more about predicting your own life. Will you stay in the same city? Will your job still be there? Will your family need more space? Could something force you to move during a weak market? People will study a mortgage rate down to the decimal point. They rarely study their own future mobility with the same seriousness, even though how long you stay might matter more than a small difference in rate. Because a home isn't a stock. You can't sell one room on a Tuesday because you need cash. You can't click a button and have the money tomorrow morning. The equity is real, but it's trapped inside the property until you sell, refinance, or borrow against it. That illiquidity can actually work in your favor, though. It stops casual spending. Every principal payment quietly turns income into home equity, which means a mortgage effectively creates forced savings. Someone who struggles to invest on their own might end up building real wealth simply by paying their mortgage for years. But forced savings still comes at a cost. Money that goes into a down payment can't also sit in an emergency fund, fund a business, pay down expensive debt, or grow somewhere else. That's the opportunity cost. A $60,000 down payment doesn't just cost $60,000. It also costs whatever that money could have earned somewhere else. That's not proof investing it somewhere else would have worked out better. Markets fall. Businesses fail. People spend money instead of investing it. It just means the down payment has to be treated as capital with real alternatives, not free money that disappears from the math. Then there's leverage, probably the strongest argument for owning a home, and also one of the biggest risks. Say you put $40,000 into a $400,000 house. If the property rises 10%, you've gained $40,000, equal to your entire down payment before costs. But leverage cuts both ways. If the house falls 10%, you lose that same $40,000. The bank's claim on the property doesn't shrink because the market dropped. You still owe every dollar of that mortgage. And this is exactly why national housing numbers can be misleading. FHFA reported home prices rose 1.7% nationally between the first quarter of 2025 and the first quarter of 2026. But that's an average. Prices rose in some markets and fell in others. You don't own the national index. You own one house on one street inside one local economy. That concentration can work beautifully in your favor. A new employer moves in, the local economy grows, schools improve, supply stays tight, demand rises, and your home benefits. But it can just as easily go the other way. A major employer leaves, insurance gets harder to find, taxes climb, the neighborhood shifts, a natural disaster changes the whole risk picture. In fact, the Federal Reserve found that more than 6 in 10 insured homeowners said their insurance costs had risen more than they expected in recent years, and some homeowners actually cut back on coverage or dropped it altogether just to manage the cost. This is the part people miss most. The principal and interest on a fixed-rate mortgage might stay perfectly stable. The actual cost of owning the house does not. Taxes rise, insurance rises, repairs rises, utilities rises. The roof doesn't care that your mortgage payment never changes. Still, that fixed payment carries real value. Inflation tends to push rents and incomes upward over time, while the principal and interest portion of a fixed mortgage stays exactly where it started. Freddie Mac actually describes this as an inflation hedging feature of ownership. Taxes, insurance, and maintenance can rise, but that original mortgage payment doesn't. For someone who stays long enough, this quietly transforms the math. A payment that feels heavy in year 1 can feel almost light by year 12, especially once income has grown, because you're repaying that debt with future dollars that are worth less than the ones you originally borrowed. That's one of homeownership's quieter advantages. Taxes, on the other hand, get oversold constantly. Mortgage interest and qualifying property taxes can be deductible, only if you itemize instead of taking the standard deduction. Insurance, utilities, repairs, principal payments, HOA fees, and most closing costs aren't deductible at all. So you can write it off should never be your main reason to buy. A deduction reduces taxable income. It doesn't refund the whole expense. Spending $1 to save a fraction of that dollar in taxes is still spending money. But not everything a home gives you shows up in a spreadsheet. Ownership gives you control. You can renovate, keep pets, plant a garden, stay without worrying a landlord will decide not to renew your lease. You get to build routines around your school district, your neighbors, your community. That stability has real economic value because people don't make every decision purely to maximize investment returns. A house gives you consumption every single day. You actually live inside the asset. That makes it fundamentally different from a stock portfolio. Nobody asks whether their couch beat the S&P 500, but we treat homes differently because a home can shelter you and appreciate at the same time. The danger starts when buyers need that appreciation just to rescue a purchase they couldn't really afford in the first place. A good home purchase should still work even if prices grow slowly for a while. You should be able to make the payment, maintain the property, and keep real reserves without depending on refinancing or a fast sale to bail you out. So the real question isn't, can the bank approve me? Banks are only checking whether the loan fits their underwriting rules. They don't know your actual life. They don't know if you're planning to switch careers, support a parent, start a business, have kids, or move cities. They don't know whether a $12,000 repair bill would wipe out what's left of your savings. The better question is, after buying this house, how much financial flexibility do I still have? Because a home can grow your net worth on paper while quietly weakening your cash position in real life. You can become richer and more fragile at the same time, and that's usually the part buyers only discover after closing. Buying a home works best when a few things line up together. You expect to stay long enough to absorb the transaction costs. The full payment still leaves room to save and handle emergencies. You have reserves left over after the down payment, not just enough to limp across the closing table. The local market supports the price without needing heroic assumptions, and you genuinely value the stability and control that comes with owning. Buying gets dangerous when the deal only works if everything goes right. A future raise, lower rates, fast appreciation, no major repairs, no job loss, no need to ever move. That's not a plan. That's a chain of favorable events wearing a disguise that says affordability. So the real economics of buying a home aren't about ownership always being the fastest route to wealth. They're about a simple trade. You're giving up liquidity and mobility in exchange for control, stability, leverage, and long-term exposure to one local market. Under the right conditions, that trade can be one of the most powerful financial decisions a household ever makes. Under the wrong conditions, it can become an expensive asset that ends up owning you instead. A house can be a wonderful home and still be a bad purchase. The goal is simply to know the difference before the keys are already in your hand.